Hello friends, today let's examine one more provision in the Income Tax Act which allows us to reduce the burden of tax on income from capital gain. Now this provision is available in section 54 EC of the Income Tax Act. Now earlier, benefit of this section would be available for the sale of any asset, but with effect from 1st April 2019, benefit of this section would be available only for the sale of assets like land, building, or both land and building. That means if the asset was sold prior to 1st April 2019, the asset can be anything: land, building, securities, jewelry, anything. But after 1st April 2019, the benefit would be available only for the sale of land or building or both. But only condition is that the asset sold must be a long-term asset. That means it must have been held for a minimum period of 24 months. Unlike other sections like 54 or 54F, this section is applicable to all types of taxpayers, that is individuals, HOFs, firms, companies, anybody. Okay. Now here the quantum to be invested is the amount of capital gains and not the consideration received. That means suppose I have sold an asset for say 1 crore rupees and the indexed cost of acquisition of which is 60 lakhs. My capital gain is 40 lakhs. So the amount that I have to invest is 40 lakhs and not 1 crore. Now this investment under section 54 EC must be made within a period of 6 months from the date of transfer of the asset. Now this 6 months may fall within that particular financial year or next, that is subsequent financial year. For example, the asset is sold in April, then within 6 months, that means before 31st October, the investment has to be made. On the other hand, if the asset is sold say in February, then the investment must be made within 6 months, that is within next August, either August or within that financial year itself. But only the restriction is that the maximum amount that can be invested under this section is 50 lakh rupees. The investments have to be made in specified assets. Now, meaning of the term, the specified asset is that it is any bond, okay, which is redeemable after 5 years. That means any bond which has a maturity period of 5 years. And this bond issued after 1st April 2018. Now, some of the examples of such bonds are bonds issued by National Highway Authority or Rural Electrification Corporation, Power Finance Corporation, etc. Okay, or any other notified companies. Now, the significance of the term 1st April 2018 is that prior to that, validity of this maturity period of this asset used to be 3 years. Now, this has been enhanced to 5 years. Under certain circumstances, benefit of this section, if it is availed of, then it can be withdrawn. That is, if the new asset, that is the bond, is transferred or converted into money. Now, what is the meaning of this term, converted into money? Earlier I said the maturity value of the bond is 5 years. Suppose I encash the bond before 5 years, that is conversion of the bonds into money. So exemption would be withdrawn in that case. We should remember that even mortgaging the bond is deemed to be conversion of the bond into money, that is on the date of borrowal. Therefore, no borrowal is also permitted on the strength of these bonds. Now, this conversion or transfer should not take place within 5 years from the date of its acquisition. As I said earlier, prior to 18, it used to be 3 years. Now, 1st April 2018 onwards, the period has been enhanced to 5 years. Okay. So, if Within this period of 5 years, the bonds are either transferred or converted into money, that is in cash. Then the amount of capital gain which was earlier claimed as exempt will be brought to tax in the year of such transfer. Now there are certain points that we need to remember in this connection. That is, the limit of investment covers sale of more than one asset in a financial year. That means, suppose I have a land and I have another building. I sell the both the assets, that is land and building. Now this restriction, when that is the benefit of section 54 EC is available, will be for the total amount of sale consideration and the capital gain derived therefrom. That means, suppose I sell a piece of land for say 40 lakhs and sell a building for say 60 lakhs. Then the maximum amount that I can invest and claim the benefit under section 54 EC is only 50 lakhs. It is not with reference to assets, but the total amount of capital gain derived by me in the year. And the amount of investment cannot be claimed as a deduction under section 80C, like your benefit for payment of insurance premium, provident fund, etc. It cannot be equated with that. And the interest earned on these bonds will be taxed in the normal rates, normal circumstances. Okay, no exemption would be available for the interest earned on these bonds. It is only the capital gain that would be exempt and not the interest earned on these bonds. Thank you, friends.